Hello, welcome to our panel today. We are going to be covering the fundraising for emerging managers, and we have an amazing panel group here. Liz Weindrucht with Barings. They're a global asset manager, and Liz has been there for 15 years in investing in the small cap, lower middle market. We have Justin Smith with Agelis Capital out of Clayton, Missouri. They just raised their first fund of $400 million. Robert Fox with McGuire Woods. They're a leading law firm, and they put on some really amazing events in the independent sponsor round, emerging managers in the healthcare space. And then we have Will Fletcher with Latticework Capital out of Dallas, Texas, that invests deal by deal in the healthcare space. My name is Jennifer Gratt-Marinucci, and I'm with Alliant Insurance. I work with our private equity group and M&A for over 18 and a half years, and we focus a lot on reps and warranty, diligence, property casualty, cyber management, liability, all those fun things you have to have within a deal. Today, we are going to be covering the market of emerging managers fundraising and how you go from working on a deal-by-deal basis to raising that first fund. We are going to be covering this morning about how it looks, how it's looked over the past couple of years. And Liz, would you like to start us off?
Sure. Can everyone hear me? Sounds like
Yes.
it. So maybe I'll spend just a second also sort of telling you sort of where we play within the broader space and what our areas of focus are, because I think that'll help inform just our views on what we're seeing today. So Barings is a large asset manager, mostly owned by a MassMutual life insurance company. I sit within a team I like to think of myself as a capital provider. We do primary fund investments as well as equity co-investments with funded and independent sponsors. And so if we're co-investing with an independent sponsor, it tends to be someone who's on the path to then raising an institutional fund. Our areas of focus tend to be all at the lower end of the market, which we define as businesses with enterprise values of $250 million and below. We're mostly focused on buyout and growth equity strategies within traditional private equity, and then value-add infrastructure strategies within real assets. We have seen a tremendous uptick in co-invest deal flow, particularly in what I'll call sort of the independent sponsor space. And I think that, one, that's always been a pretty robust ecosystem of folks, but I also think that on one hand, the bar towards raising an institutional blind pool fund continues to get higher. So I think the market now dictates that you need to at least have some deals under your belt, regardless of maybe the institution that you came from. There's obviously exceptions to the rule, including some that are on the stage with us, but for the most part, you need to get some deals done as an independent sponsor before you can raise a fund. But I will say the first half of 2025 was fairly slow, and then we blew the doors out in the second half of the year, which I don't love doing. If we're working to get a bunch of deals approved in the fourth quarter, you tend to have a look back and say, gosh, maybe we shouldn't have done that. But I'm hoping that this year was the exception, mostly because these were really high quality deals from sponsors who we know and like and just want to get some deals done with. And so I'm hopeful that there's been a bit of a kind of an unlock in the capital that's out there, and the capital flows are going to start to normalize.
Justin Smith, Managing Director, Head of Business Development with Agelis Capital. We're a little under 2 years old, and we're founded by two best friends who started their careers at Audax in Boston. Worked together there for several years. One peeled off to St. Louis to join Thompson Street Capital. The other was a lifer at Audax. When they decided to start Agelis in early 24, the St. Louis guy, Jeff, won the coin toss, so we all moved to St. Louis. So I'm a Texas native. I've spent 12 years in PE business development in Texas for a couple of funds prior to joining Agelis. What makes our story unique, I think, is the speed of the fundraise. We launched formally in April of 24, and 18 weeks later had raised our debut fund of $400 million. And I think the key to that quick fundraise was really two things. Jeff and Bo, who had been best friends, started their careers together. Over their 15 years careers prior to joining Agelis, starting Agelis, had done the exact same type of deals repeatedly, non-discretionary services roll-ups, had a great track record, and wanted to do the exact same thing at Agelis. So continuity of strategy and good track record really helped us get that fundraise going. To date, we're a little under 50% deployed in Fund 1, doing exactly that, the non-discretionary services roll-ups.
Hi, I'm Robert Fox. As head of the Emerging Manager Program at McGuire-Woods, not only do we lead the the conference, which has become very well known for connecting LPs and emerging managers with their fundraisers. I also am speaking a majority of my day-to-day with LPs like Liz and others, really getting a pulse on what is going on in the marketplace. Aside from that, we see a lot of deal activities. You can imagine being a law firm. We see the deal activity, we see the fundraise activity, and so forth. All that to kind of lay the foundation that this year has been remarkably busy. We've seen a lot of deal processes launch immediately out the gates, first week. I thought we'd have a little bit of runway to chill out and ease into the year, but no way. That will be punctuated this year by what we're anticipating is some fundraise activity in Q1, both for Fund 1 and Fund 2. The interesting contrast is that in 2025, at least from our perspective, I can't speak for other LPs out there, but we saw a lot lighter fundraise activity last year and a lot more emphasis on deal-by-deal activity for independent sponsors, primarily looking to establish a track record leading up to their fund. Really, it seemed like there was a lot of preparation to be ready to check all those boxes for LPs and their requirements for that first-time fundraise. And that was really an interesting contrast to 23 and 24, where we saw a decent amount of fund activity, but it was really challenged. And we saw a lot of managers just struggling to get their fundraises done. So just to give you a little bit of a cadence of how the last few years have played out.
Yeah, hi, I'm Will Fletcher. I work at Latticework Capital. We're a lower middle market healthcare dedicated fund. Our path is a little more similar to what Liz had said, where we did a pre-fund deal that helped launch our first fund. We finalized our second fund back in 2024. Would agree with Rob that it was probably one of the more challenging fundraising environments, and I think as we look forward to this year, expect that to get better, but also a lot more crowded because folks have been on the sideline for the past few years, and so though things are better, it will be very, very crowded, and liquidity is king, and so returning money to LPs is a good way to ask them to write you another check.
Thank you. So as you're raising your first fund, how important is it to get that big investor to your fundraising? Does it give you momentum? So what's been your experience, and how do you look at that, Liz, whenever you're investing in funds?
I think I'll let the funded sponsors go first here, just because, for me as an outsider and as a potential anchor, it's definitely something that we look for, but I would say it's also become a pretty crowded space, so there's a lot of term sheets floating around out there. There's a lot of deals to be had or not in that space, so I will defer to these guys up here, and we'll maybe jump in.
Yeah, it's very important. So our anchor investor started having conversations with our founders about 3 months prior to the formal launch of the fund. And we launched the fund once that anchor investor said, yeah, let's go. And they came in for 1/4 of our fund. And we had conversations with numerous other LPs, potential LPs, during those same time periods. And they were all like, yeah, that sounds great, keep us posted. But once the anchor formally signed docs, everyone else was like lemmings, because they came in for a large chunk, and they had done a lot of diligence, and it was a well-known anchor. So I think it's the quality of the anchor is important. How big are they coming in for, and can they vouch for you and your strategy? And so, yeah, when the first anchor came in, that really accelerated everything else, and I don't know if we'd be here without that anchor.
Awesome. Will?
Yeah, we did not have an anchor investor. I would agree with Justin that it probably accelerates things quite a bit. You do need, for us, we had to get, call it 3 to 5 investors to get, somewhere between 40-50% of your fund. And then that creates that scarcity value, whereas when you have an anchor, it creates a scarcity value a little bit, which you can kind of force pace on your LPs to kind of finalize their diligence, get through their processes, and make an investment decision or not. But until you get kind of that, call it bolus dose of LP money fully committed, you don't have that scarcity to drive people, and folks will want to just keep following you, and everybody wants to be the last check-in. So an anchor certainly accelerates things, but if you can go get 4 or 5 other folks to commit early, and they're good, well-known brands, you can kind of create that factor a little bit on your own without an anchor. But it will take a lot more time.
It's true. I think you also have to be pretty careful about what you give up to that anchor too, because on one hand, yes, it creates a sense of scarcity. It creates this sort of buzz and demand for your fund. But on the other side of it, I've seen term sheets out there that the GP is not going to be profitable for like at least 3 funds because of what they're giving up from a revenue standpoint. So that's just for their own kind of, edification. They're building their business. But if you're going to take that anchor money but give up all of the co-invest rights to your anchor, like that's going to probably turn off the part of the market that likes to come in and co-invest. I've seen instances, and we did a lot of work on a fund last year that had a very large anchor, and it was a family office, very, very sophisticated within their sort of investment niche, but hadn't done a ton of work on the fund that they were anchoring from like a diligence standpoint and the way that an LP would do diligence, right? Like I'm not saying they didn't do any, but they did plenty. But when we were asking questions, second, third order questions around track record and terms and things like that, like it was clear that they hadn't done that level of work too. And so I'd say the sophistication of your anchor and who they are means a lot. You guys have a great anchor, and that also I think spoke to kind of credibility in the market. So not all anchors are created equally, is I guess probably the best way to put it. But no question that and/or a first close will certainly help kind of draw others kind of out, because there are a lot of investors who say, "Gosh, this sounds great. Call me after your first close," right? If it's with an anchor, or if it's with someone else.
Awesome. So let's talk about co-investment. It's everywhere, and I've seen a lot of my clients co-investing. What should GPs and LPs understand about co-investing? And maybe for some people that don't understand the value of co-investing, kind of explain that as well. Would you like to go, Justin?
Sure. Co-invest was certainly important to our LP base. So we have a $400 million committed fund, and then an additional 200 of soft commitments with co-invest, and that's great economics. That's pretty much fee-free co-invest for those investors. So we're looking to deploy a total of $600 million with our strategy. And anytime we have a platform nearing close, we go out to our LPs, get their blessing, and offer them co-invest. And we only have about a dozen institutional LPs, and so what can get tricky is breaking down who wants what. If it's a great investment, everyone wants to put a ton in. If no one wants anything, then we probably need to go back to IC and figure out what's wrong with our investment. But yeah, $200 million, so 50% of our fund on top of that is allocated for co-invest. And we're excited about that. It really helps validate our investment when they want to come in and invest meaningfully behind our platforms.
Awesome. Will?
Yeah, I mean, co-investment's great from a couple perspectives for the LPs. One, they get to kind of see the GP in action, and sometimes they'll co-invest in an earlier deal in advance of maybe a future fundraise, so you build a track record with that LP. The LP also bundles that with primary fund commitments, and so they lower their fee base into the investments they're making with you. But the co-invest process looks different for different firms. Some folks will rely on your diligence, and if you want to do it, they'll do it with you, and they move very quickly. Others want to do their own pretty fulsome underwriting, and not that that's a bad thing. You just need to understand that as you think about the pace of the deal, and make sure that the co-investment process matches the pace you have to do to get the deal done.
So every LP tells you that they want to co-invest is what I found. Everyone out there talks about how much they love to do it, but not everyone can put pen to paper in the way that is necessary when it's kind of time to do that. So it's more, I just sort of reflecting on what you said, Will, around knowing and understanding, like if you're out there and you have LPs who want to co-invest, to ask them like, hey, like what's your process like? Like how do you guys do it? If some will say, I've underwritten this GP, this deal's within their strike zone, I'm going to come in, like yes. Others, to your point, want to do a more fulsome underwrite of the deal and have to go through all their internal checks, balances, approval processes, and you want to make sure that everyone shows up on closing day with a check. So that's, it can be hard to balance. And just from an LP perspective, managing allocation is really, really tough because if you've got 50 million available, if the GP, you probably want to split that into, a couple of 25s, right? Like you don't want 20 people going through a co-invest process, but at the same time, you want to make sure everyone is getting the bite size that's appropriate for them and not, having them do all of their work investment process and then coming back at the close and saying, you said you wanted 25, but we can only give you 6. So like that's a disappointing outcome for everybody. It's really, really tough to balance.
If I can just add one more quick note, when it comes to first-time funds that are looking to raise to raise their fund, a lot of times LPs want to see an established track record in advance of that. One thing that we've been noticing is an interesting trend over the last few years at McGuire Woods. As you know, we do the Independent Sponsor Conference, we do the Emerging Manager Conference, and so typically those two things have been fairly separate. We've been seeing over the last few years, the lines are blurring quite a bit. We're seeing a lot of LPs that have indicated interest to do independent sponsor deals for those that are maybe looking to raise a fund in the next, let's call it 12 to 18 months. It gives them a really good perspective on how the sponsor works, the emerging manager, and how they're going to be doing deals, what their focus is like on a lighter commitment basis. They're not just throwing money into a blind pool, rather they're actually co-investing on a deal. So that's been an interesting trend that we've been seeing a lot of interest from LPs lately. And I'd say, one of the other questions that's coming up from both the LP and the GP perspective is the discussion around warehousing deals. Maybe that last, let's call it like maybe the fourth or fifth deal, partnering with an LP and teeing that up to be able to put that into the first fund as part of that commitment. So just some interesting dynamics that are evolving along with the marketplace.
Awesome, thank you. So now you've raised a fund. So how do you put it into action? How do you invest? And it's a hyper-competitive market. So I just had an event last week, and I asked all the private equity firms that attended, how do they source deals? So how do you source deals, and how do you let your LPs know that you have a really great plan to bring in good deals, because everybody's out there looking. And I found through asking that question, a lot of people have different ways that they are sourcing deals. I was super surprised. So Will, would you like to go first?
Yeah, it's interesting. I feel like when we started about 10 years ago, focus was more on our track record and what were the deals you had done, what do you plan to do, and as we've gotten into Fund 2 and Fund 1 fundraising even, there's been a significantly higher focus on our BD process. So how are you finding these deals? A lot of emerging managers came from much larger institutions where, if you're a 10 billion AUM firm and you've been around for decades, deals are going to come your way because you got money to spend. You got to make sure you cultivate your relationships, that those follow you to your new emerging fund. And it's something LPs seem to be focusing on quite a bit in the past, I would say 5 to 7 years more so than maybe I saw 10 years ago.
Yeah, I completely agree. In fact, I was surprised when we first launched. I was on the road with the founders in meetings with LPs, and I was often asked to present and talk in detail about the strategy for BD, how we'd go to market, what's our infrastructure looking like, are we going to be sourcing through intermediaries or proprietary, and just having to peel back the onion multiple layers. It was good to know that BD is valued, and a lot of BD professionals in the room, so we can sleep well at night, but there's a lot of scrutiny in terms of the way that we're going to market and sourcing deals for the fund. And I think Jealous is an intermediary first focused fund, so building relationships with bankers and brokers is critical for us. We do that by attending a lot of events such as this, coast to coast annually, building infrastructure to capture the data and deal flow and analyze that effectively. So a lot of investment in CRM, AI technology, and private market databases, et cetera, and articulating that to the LPs throughout the year. They come back quarterly and want to sit down with us and want to see our deal flow metrics. So it's high pressure, but it's also exciting to know that our function's valued.
No, I would just say it's been really interesting to watch the industry evolve in that way, because I think 10, 15 years ago, this would not have been the same conversation. It would have been, well, I've been in the industry for 15, 20 years. I know everyone in healthcare, and I know all these operators, and I've done all these deals, and the deals just come to me. And it was very like human capital, like very individually focused. And I think that the really good groups that are out there have said, like, yes, we have those relationships. Let's harness them. Let's systematize them. And then also let's build a database. Let's build a CRM. There's how many brokers out there? Thousands. So let's make sure that we're seeing them on a regular basis, either emailing them or calling them and hitting, this is still like a pretty good old-fashioned like shoe leather kind of business, right? Where you're going to have to, fly all over the country to meet the right person to then get introduced for that next deal. And particularly within the lower end of the market, your next deal is going to potentially come from a shop that does one day, maybe two a year, right? Like, so you got to make sure that you're at the top of the list for all those folks and that you have your system set, because most of them are just going to show the deal to the last person they talk to.
I'll just add that there's a great stat I heard last year. There are more private equity firms in America than there are McDonald's restaurants. And so there's so much competition for an increasingly stagnant amount of deal flow if you look back over the last 3 years. And banks are running tighter processes. So you have massive amounts of new private equity entrants in the market, static deal flow, and processes going out to less groups. So it makes our job that much more difficult. And I think that LPs recognize that. And that's why they're asking all these questions.
Well, Justin, that explains why we have so many wonky private equity names out there. I figured the startup that I want to do is a magic 8-ball of private equity firm names. You shake it and you get like a rock into something. Anyway, just from my perspective, I think that, the one thing when you're seeing a lot of decks come across for fundraisers, the one thing that LPs do want to see is if you do have some interesting, unique angle to source deals, it's something that should be highlighted. It's something that you should note. Like I've known groups that, went to public companies to find out who their suppliers were, and that was their angle. There have been others that use their operator's background to the point that you're bringing up. I mean, if you have some unique angle, it's absolutely imperative that you convey that because, separating yourself apart from all the other McDonald's franchises out there is super, super critical.
Thank you. So as you're going to market, back in the day, I think more firms were generalist in nature. They were very opportunistic. And definitely on the independent sponsor side, you can be a little bit more flexible. But as you've raised your fund, LPs want to know that you know what you're investing in and you're really good at investing in that industry or sub-industry. So how important do you feel that is to an LP having a very clear, concise strategy going to market with what you are investing in? Will?
Yeah, I mean, I think specialization is immensely important on a number of different fronts. First, it helps us win business, I feel like, with business owners, and that kind of helps our sourcing as you think about LPs. And, time is our most finite resource, and so specializing helps us really get through the deal flow, know which ones we want to spend time on, know which ones we want to pass on. And then I think if you even look up market to firms you think are generalists, a lot of their team members are specialists, so they specialize in different verticals. So I think it's very important, particularly as the market becomes more and more competitive. Anything you can do to get an edge is very important.
I agree with Will. Our LPs would rather us pay a nosebleed multiple to acquire a platform in a sector that we spent a year researching. Right? Hopefully it's not the first deal in that sector we've seen. We would have lost on several others and gotten smarter, but sector specialization is critical for us, and our LPs, it matters to them a lot. So as opposed to being generalist and seeking value in processes, being convicted on where you want to spend time, knowing that sector, and knowing when to get aggressive matters. And we've seen that from our LPs. We've chased deals aggressively and been surprised at how, to the degree that was welcomed and where co-invest was offered. So that's the strategy that we pursue, is very thesis-driven and getting selectively aggressive on certain sectors and subsectors.
No, I think it speaks also just the evolution of the market, right? Again, 10, 15 years ago, you could get away with having, a pretty generalist orientation to your strategy, and maybe you would do 4 or 5 sectors as, kind of a small firm and team. And I think that you've got to be able to differentiate yourself today. And I think sector focus is one of them. BD and kind of sourcing is another one. But I mean, because we do so much at the small end of the market, there are some groups out there that say like, hey, like our specialization is in this sort of the small cap effect across a variety of industries. And we get a lot of pushback at the IC when we bring those opportunities through. And we've gotten a couple of things where, they're holding on for daylight right now, but it's like, hey, it's a generalist, and why do we have conviction in this sort of generalist type strategy? Like we need a sector focus, and to your point, it's, even sector focused teams or even sector focused partners, as opposed to, well, we're all generalists, everyone does a little bit of everything.
And if I can add one more thought to that, specialty does not always necessarily mean vertical or sector. It can also mean the type of deal, like a value-oriented deal. Groups
That's a good point.
Yeah, they focus on carve-outs. As long as there is a certain type of deal that is part of your secret sauce, definitely like that is also a form of specialty. We call it value-oriented deals, whether they're turnarounds or so forth. And then just one last note, like speaking to LPs all the time, I can't tell you one that said we like a generalist opportunistic investor. It is always a sector specialist or somebody who specializes in a type of deal. Those are the ones that they're exactly what they're looking for.
So, have you known or maybe experienced somebody that your friend that has invested and gone outside their mandate, and how do LPs look at that? Maybe you've never done that. Well, have you ever, like your firm, ever looked into a deal that you're just so excited about, even though it's not within your perimeters?
I mean, yeah, we have a pretty hard mandate where we say we invest in sub $10 million lower middle market founder-led healthcare businesses. Kind of one simple sentence. So when we're at IC and we talk about deals coming through, if it's on the cusp and it's a little above it, we've drawn a pretty hard line in the sand that we want to do what we say we're going to do. And so we don't even necessarily go to the LPAC to discuss it. We just say, you told us you wanted lower sub 10 million. We draw a hard line in the sand and we don't do above that. Now, hopefully we grow our companies much larger than 10 million, but as a starting point, our mandate is, single digit EBITDA companies in the healthcare space.
Yeah, our LPs are focused a lot on size of investments. And our mandate is anywhere from 2 to 20 of EBITDA. But if things start creeping up towards 20 and we should put something in front of them, we will get questions like, are you sure this is the right investment for you? If you do a buy and build that starts at 5 of EBITDA and you put another 20, 30 million of accreted EBITDA via add-ons, that makes sense to us. But if you're starting at 18 or 20, help me understand how that aligns with your investment strategy. So keeping us disciplined on size has been something they've been focused on.
You never want your name associated with the term strategy drift, just because when it comes time to raise your next fund, the most important thing that you're going to need to be able to demonstrate beyond just having generated amazing returns for your investors is that you did what you said you were going to do. And so if it's an interesting, cool, like SPV and you do it outside your fund, like it's still, you're devoting the time and the resources of your firm and what you're getting paid a management fee to do to go do other things. And so, look, there are a lot of groups out there that got really excited about SPACs and sort of like the de-SPACing kind of trend out there. There are some, and I'm even going to put this, there's all groups out there that, and no one on stage has, who raise, I'm going to call it sort of adjacent product, right? So you've got a lot of the larger buyout shops are now raising the small cap funds or the back to our roots funds. And I think that when you start to do things that are sort of outside of what you said you would do, you just, the trust that you've built with your investors erodes. And that's like the one thing you can't really quantify. That's probably one of the most important things that you have, which is your reputation. We're in a long-term business. We're all in these businesses for 10 plus years from a fund perspective. So it's just really, really important to be able to come back and say, yep, we did exactly what we said we were going to do. Because also if that adjacent thing goes wrong, like it's pretty obvious why.
And I'll add one more thought again. It also matters when you're going out to raise a fund. If you're spinning out from your firm, I think the most successful first-time funds are the ones, if they're spinning out a firm, that they're rebooting their old strategy. They're going back to their roots where maybe their firm has grown so large, their fund is so big, but they really want to get back to the lower middle market within that space. And I think LPs acknowledge that and they respect that and they appreciate that rigor and that discipline to really stay in the lane like Liz mentions.
Let's talk about communication with your LPs. I've heard so many times you're always raising money. So what kind of communication do you have with your LPs? And I would think even more so with co-investment. So, Will?
Yeah, I would agree. You're always fundraising. It's helpful to chat with folks even when you're not formally fundraising with natural touch points, whether that be conferences, deal announcements, et cetera. It just builds more touch points. So when you are formally fundraising, they can say, to their investment committees, I've tracked this GP for 3 years. Like we've invited some folks to our annual meeting 2 or 3 years in advance of them investing into our second fund so that they get to know us. And so I think more touch points is better. It gives the LP a chance to take notes and say, okay, they said they were going to do this. They were going to close 2 platforms. Did they actually do that? They said they were going to sell this company. Did they actually follow through and sell that? So it just gives it gives you credibility if you do what you said you were going to do, and the LPs can kind of go back and check their notes. And so more touch points generally better. Obviously, without wasting people's time. Time is everybody's most valuable resource.
Agreed. The AGM is the most important time of the year for communicating with both current and prospective LPs. That's your annual growth meeting, your annual meeting. Ours was November of last year. The partners had us planning for that like 4 months in advance, like 50-page deck going around, 50 versions of it. So it was very important. And we had just as many prospective LPs there as we did our active LP base. And that was important. It led to a lot of follow-on conversations, a couple of soft commitments for Fund 2, which we're excited about. But in addition to the AGM, monthly we're on the phone with most of our LPs, either to show them co-invest opportunities, give them updates, pick their brains, leverage their networks for investment ideas we have. So it's important to us to have regular contact with our LP base, both active and potential future LPs.
Just to add to that, the in-person meeting is back, y'all. Like, I'm not saying that GPs have to go take these massive road shows, but there's still not a substitute for sort of a good in-person meeting. And so I always appreciate when I get the email or the phone call. It's like, hey, we're going to be in Charlotte. We're meeting with a management team. Or we've got a board meeting here. You know, could we stop by and say hello? Like, seeing sort of those, I call it kind of the, you know, off the cadence of the fundraise and even off the cadence of the annual meeting, when it's a, you know, maybe just a deal partner or maybe, you know, the BD person, just being able to deepen and develop relationships with more people in the firm than maybe just the founding partner or the IR partner, I think goes pretty far, is incredibly powerful, and LPs actually really appreciate it. Now they have to be in office. We're in office at least 4 days a week, so I'll always take a meeting in Charlotte. But it's actually, I'm heartened that it's gotten, I feel like we sort of come back from COVID. It's taken, you know, 6 years or so, but now I think like the in-person meetings are super helpful.
That's a really good point, where, you know, going and meeting with somebody face to face is a much stronger relationship than just meeting somebody on the Zoom screen, for sure. And as somebody who sees a lot of discouragement and a lot of rejection between first-time fund managers or those raising first-time funds and LPs, you know, that discouragement can be really tough. But I always encourage these groups raising funds to get these LPs into their CRM or a mailing program, not to, like, you know, hound them or anything, but rather sending, you know, like Will says, you know, regular updates about, hey, we closed a deal, or hey, we just, you know, secured an anchor investor. You know, just keep them apprised of how things are developing, because oftentimes these LPs are not maybe interested in investing in Fund 1, but they want to track the fund progress to Fund 2 or 3. And so you know, there is a potential that an LP may say yes today or may say no today, but tomorrow it might be a yes. It might just be a bandwidth issue, for that matter. And so it's just, you can't always take no as a solid rejection. And I guess the only other point that I would mention is that, you know, let's say, you know, managers who close a Fund 1, they have their list of rejections from LPs, but the point that I hear over and over and over, it's so much easier to have a meeting with an LP when you're not marketing a fund. It's so much easier to go and say, hey, this is the success that we've just achieved, and to be able to go to that, and it creates a sense of scarcity about, hey, sorry, you missed the boat, but guess what? Fund number 2 boat is going to be right back here. So just never, you know, be too discouraged by a no, because it might come around again.
Very good point. Thank you all for all your additions and value that you're adding to people that are raising their first fund. Thank you so much for your time today.
Thank you.